Good evening, welcome to everybody. It is a great pleasure, in fact, to give you a very warm welcome to this Lewis Alumni Masterclass on European financial market. It is a really great pleasure to work with you tonight and in fact discuss very important issues in and around financial markets. We do have two extremely sage and expert speakers who are going to be discussing about the issues. Alessandro Barnaba, who is partner of Merlyn Advisor, and Ada Di Marzo is a partner and director of Bain and Company in France. Alessandro and Ada will entertain us for the next hour or so, and they will be moderated by Professor Giorgio Di Giorgio, who is also Vice Rector, Deputy Rector for Faculty and Organizations, whereas Andrea Battista, who is the President of the Lewis Alumni Association, is going to be doing the concluding remarks. Let me just spend a few words about the format that we have launched together with the Lewis, in fact, and the Lewis Alumni Association has decided to launch together. As Lewis University, we are committed to, as we say, to inspire a better world and a better society through scholarship and education in social sciences. We are a social science university, and we do rely upon our research, our extended relationship with the, as we call it, real world, again, to offer discussions, debates, and also, ideas in and around social sciences issues. Today we're going to be discussing about European financial markets, and again we have two very important speakers. As our Prime Minister told us yesterday, Lewis has been able to create a space for its own reputation nationally and internationally. Of course we're proud of it, but also we are pretty much aware that we need to further our commitment in and around quality and excellence in academia. And we do it, and we would like to do that, by relying upon our extended community. We consider ourselves as an academic community, which of course does include staff, professors and students, but also alumni. And in this specific respect, the Lewis Alumni Association is a fantastic collection of ideas, stories, commitments, and of great people that have made their own ways, they've created their own paths to become leaders, and therefore they're very much a source of inspiration for our very ambitious students. So I do think we're going to be exposed to very interesting points in and around European financial markets. It's a great opportunity for our students community to learn from our former students, our alumni, and also it's a way to create a stronger connections amongst the nodes or the different communities. We have Alessandro is speaking from London tonight, and I guess Ada is speaking from Paris. We are in Rome, so basically we're connecting three capitals via this alumni masterclass. I'll stop here. So without further ado, I'll leave the floor to Giorgio. Giorgio is going to be moderating the masterclass. I would like just to say that as you see, we have a WhatsApp number to actually collect and address your questions. Please do so, and really, buon lavoro.
Thank you, Andrea. Welcome everybody to this interesting meeting. We are going to discuss about the evolution of financial markets with a particular focus on Europe, but we will focus on the global evolution of finance in a particular period of our economic history, in which all the countries in the world have been hit by this tremendous double shock that is the pandemic emergency burnt out in between January and February of 2020. So let me again introduce our main speakers. Ada Di Marzo from Paris is the managing director of Bain, France, and she's been working long consulting on financial services. So she's an expert, and I'm gonna ask Ada several questions about what she thinks are the new needs of users of finance in this period, and how the financial actors are reacting to these changing needs in a scenario that is changing in a very fast way. And then Alessandro Barnaba, who's the founder of Merlyn Advisory and is a former chairman of investment banking for JP Morgan. Alessandro has a long experience in London and has focused on global capital markets throughout his career. So I think we really have two highly distinguished speakers today. We are happy to have them on board. I will ask them several questions, but let me first start with providing a very quick sketch of the period in which we are living. You know, we are in the middle of this pandemic emergency, and 2020 will be remembered as a year in which the global economy went into a recession. This never actually happened in the history of the world after the Second World War. Also in the terrible year of 2009, right after the collapse of Lehman Brothers, actually the industrial countries were in a recession, but overall the world economy succeeded in staying more or less on balance given the positive contribution of the emerging economies. This is something that is really different now. All countries in the world are expected to be growing in negative terms, to be decelerating, to be viewing a reduction in their GDP, with negative growth rates that range from like -4, 5%, like in economy like the US, for example, to -10% in the euro area, with some exception plus or minus. And the same kind of negative rates are also hitting some of the major economies in the world. The only exception is, once again, China, where everything started, by the way. And China is the only country that is expected to grow at around 2% this year, still a positive number, although much lower than what we were used to see in the past. But China is the only economy that is positively contributing to economic growth. And this will have some effects also in 2021 and in the next years, and will have an impact on the new geopolitical relations that will govern our world in the next decade. No doubt on that, and we are trying to speculate about also a more pronounced role of China, even in financial markets, even in banking, even in the Western world in the next months. So before we enter into this double negative shock that simultaneously hit production and demand of goods and services with the lockdowns, the closure of different productive activities, and the impossibility of the very difficulty that many households face in buying goods and services, before we enter into this period, how was the economy going? Well, the economy already in 2019 was on a decelerating trend, with a reduction in the rhythm of growth of world trade, that is usually one of the big drivers of economic growth. And there were lots of political uncertainties linked to Brexit in Europe, to the upcoming US elections that we have just witnessed the result, or actually so far the results that have been obtained in this very strange and challenged campaign. And also the reduction in the rate of growth of China was already providing some negative impact on the growth of other economies. But overall, the monetary policies were in an accommodative or expansionary mood. The liquidity was abundant in financial markets. So at the end of 2019, actually financial markets were in a very good situation, with equities at their best. The returns in the bond markets were very low. There were some risks, but overall also the financial situation of firms and of financial intermediaries was much sounder with respect to before the burst of the Lehman crisis, and banks were much more capitalized. So overall, the valuations of assets were, although generous, not completely disaligned with the fundamentals of firms. Now we are facing a new period in which, after a dramatic drop in March, financial markets have been returning to good quotations, to good values, although in this case there are clearly some fears about the possibility that these values will be maintained, notwithstanding the strong support of fiscal and monetary policies. So this is the world in which we are living, and we can now move to addressing what has been the major changes in finance that we have witnessed in this period. This period has also seen the coming of, or the acceleration of, some trends that were already in place in the years before, and these are clearly linked with some important drivers like technology, digital innovation, and regulation. And we are going to talk about these. Let me start with a question, first question to Ada. Ada, I would like you to tell us something about what you think are the more important new needs of the financial users, that is, of households, firms, in this new world in which we are living.
Yeah. Good evening, everybody. I'm very happy to be with all of you this night. Yes, a lot of changes, because actually we have been going through a very disruptive period. And if we look at consumers, but also corporate, there are a number of common trends that have changed. The first one is really the fact that we have been forced to corporate and consumer to interact much more digitally with the financial institution. And this means that the level of expectation going forward about doing easily and with right speed and reliability in terms of a transaction has become much more new normal than it was before. And actually, we can also, I would say, realize that in terms of digital maturity, 3 months have made a progress of 4 or 5 years in terms of the ability and the appetite of consumers, but also firms to interact almost on a digital basis with their financial institution, notably banks. So this is a first trend and first expectation that are I would say, structurally changing the way clients are interacting with financial institutions. The second trend, I think, is the fact that as far as market volatility went up, and also that there is this long-standing low interest rate scenario, the whole issue about investment and savings, both for consumers but also for corporate, has become quite an important point, because with the level of uncertainty in the crisis, deposits have gone up quite importantly. I think there is quite plus 25% in the second quarter of 2020 versus 2019. It is a huge jump, and the point is about people are taking much more close look at what they do with their savings. And so the expectation versus financial institutions are quite changing, even for people who are not, I would say, in high affluent range, but also for people who have been holding a lot of cash, holding money funds that are not yielding a lot. Then there is a huge amount of deposit that has to be redirected somewhere. And the role of banks, the expectation about a bank, but also an insurance company or an investment company, are of having a much more higher guidance, but also a lot of pedagogy has to be done in order that we embrace properly with consumers and firms, a period where we have to raise the awareness about the fact that to get more yield, there is an intrinsic higher risk in terms of investment. This is quite an important point. For example, in country like France, where life insurance and monetary funds within life insurance have been quite a big chunk of the market, there is a huge issue about how this whole part of savings, we're talking about more than 1 trillion in France only, will move and will be redirected. But then there are other trends that are changing durably. The awareness about protection, that could be health protection, life protection. There is the need to make sure that financial institutions not only provide the right level of protection and guarantee, but also the level of services and advisory that comes after. And last but not least, I would rather say on the wholesale and SME side, of course, the ability to manage a much more higher volatility in terms of the business, that could be forex, that could be interest rate, raise the point about having the right tools and the right ability to hedge those risks, face the risk of redefining the supply chain financing is a big point for the future. A lot of industry have been facing a broke in the supply chain, and these are honestly very important needs for the future. Last but not least, I think there is a point about the awareness and the need to be protected about cybersecurity. More digital interaction, more digital transaction will, of course, increase the level of this risk. And I think from February to April 2020, the number of attacks registered in the financial sector in Eurozone has increased to more than 200%. So it gives you the amplitude of this kind of phenomenon, and also the amplitude of what could be the needs from clients and corporates about that topic.
Okay, thank you, Ada. So let me switch to Alessandro. As I mentioned before, technology and innovation are two driving factors of change, but also regulation surely is one. And I would like to ask you, what do you think are the most evident changes in the structure and the functioning of global capital markets, with particular emphasis on European markets? But I mean, you can actually talk about the evolution of global capital markets as well.
Thank you, Giorgio, and thank you everybody for having me here, and welcome everybody to this conference. So I think that you've briefly touched upon it at the beginning of your introduction, Giorgio. What we've seen happening in the last few years has been a quite dramatic evolution of the financial markets. I think that the main push to the change has happened clearly with the financial crisis of 2008, that then for Europe moved into a sovereign crisis in 2011, 2012, and I think that that has been probably the moment where most of the regulation push has happened in Europe. In the US, which is has historically been always the driver of any regulatory push, it they didn't have a sovereign crisis in 2012, but they clearly the subprime crisis of 2008 hit the US extremely hard, and the amount of changes that the United States and then Europe and the rest of the world put together in the years that followed the financial crisis have been enormous. Have been enormous in several respects. It's been enormous mainly in terms of the regulatory capital requirements that they have imposed on banks that have historically been quite undercapitalized, if I can use a generalization, but especially the universe of the so-called broker dealers, i.e. those that did not have a banking license, but that could have still operated in the financial market space, where almost operating with an unlimited potential amount of leverage. The banks still had, already had at the time some capital requirements, obviously, but the rules that were defining the capital absorption of each individual financial product were extremely different pre-crisis and post-crisis. So this created a general push towards a much stronger capitalization of the financial sector, much more regulation also for entities that were not regulated before the financial crisis and that became regulated after the financial crisis from a capital adequacy point of view. And this, as you were mentioning, created an environment with much stronger financial institutions and that could approach and come into the crisis that we have seen due to the COVID pandemic in a much stronger way. And this is what has also allowed the financial sector to sustain the stresses that the pandemic has created on one side on the economy and on the other side on the financial market asset prices in a much better way than they would have probably have been able to do pre-changes in the regulation. However, these changes in the regulation created a lot of other effects. A lot of other effects that have generated some unwanted consequences as well. I think that the biggest unwanted consequences of the financial regulation has been the fact of creating some barriers to entry significantly higher for potential newcomers into the financial markets. They have created some structural costs to run a financial market business for the existing players that for many meant the need to step out of the financial markets. And as a consequence, has created a process of consolidation among financial players. The bigger players managed to gain significant market share, either directly or through acquisitions of other players. And now we're facing with significantly stronger and more capitalized players in the financial markets, but a lot less players in the financial markets, with all the consequences that this has on clearly the ability for the users of financial products and to have competitive prices across the board. I have to say that so far, we haven't seen any obvious abuse of these dominant positions that some of the banks have achieved. I spent 25 years at JP Morgan, and JP Morgan has clearly been one of the winners coming out of the financial crisis and the beneficiary of the additional regulation. So despite the fact that we were all upset and to have to deal with a lot more regulation, with having increased capital requirements, to see our return on capital and return on equity dropping, at the same time we realized that our market share was growing so much that in the end was more than compensating any drop in the redditivity of the individual transaction. The second big change that has happened in the last few years that is, I would add, is also a consequence of this concentration and the ability of a smaller number of players with a lot more resources than what you normally would have had on average in the past, has created a dramatic push into technology, which is what both Giorgio and Ada were referring to. And I think that this has started to create a push in the financial sector, a sort of arms race among the different players on who was capable of developing the best technology platforms to perform a lot of the activities that in the past used to be manual or used to be done by humans. And the race was not only on the front-end platforms that clients of the financial institutions were seeing and interacting with the financial institutions with, but were mainly on the back end and the ability of using electronic trading platforms to optimize the client flows that were generated every single day dealing with clients. They were about reducing the latency in between when the information was put in, either received or put in by the trader into the stock exchange or the financial market where the transaction needed to happen in the shortest period of the delay, with the shortest possible delay in between one action and the response. And this has created budgets for technology spend at some of the biggest institutions that are just mind-blowing. I mean, if I just think about how much JP Morgan is spending every year in technology, that number, I mean, at least the last year I was there, was $11 billion per year. So we're talking about numbers that are just out of any imagination. If somebody was thinking about it with the eyes of the world that we were living in pre-financial crisis, but that nowadays are essential to keep on competing.
Thank you, Alessandro. I think you made a very interesting point, and I would like to focus on this, because regulation actually was introduced with the idea to attain stability, to protect investors, to provide more efficiency in the working of the financial sector. And regulation comes with costs. So, as you said, everybody was in the industry reluctant and opposing the emergency of new costs to comply with the new strong regulation that emerged. But then actually regulation also helped the big incumbents, if you wish, to achieve stronger positions, to increase their market share. And this is something that we actually observe, and we have observed in the single countries, also in Europe. We are probably gonna see something more in the future, but you are underlining that this is also evident at the global level. I mean, the market share at the world level is increasing for some of the big players. I would like Ada to continue this kind of reflection, also by thinking about whether this trend can also emerge in the retail scenarios. I mean, this is clearly evident in the wholesale business, but are we going to see something like this also in retail banking, also in retail financial services in the future? And in a fast-changing world, what, in your opinion, are going to be the successful strategies of banks, financial insurance companies, financial companies, asset managers?
I think that, Giorgio, on a number of dimensions, I think the way financial institutions will run their business will have in a way or another to change, because we have changed, let me say, the set of values and the way we measure the maturity against those ones. I will pick up a couple of points to just highlight how this can affect the way banks and financial institutions will run the business, I would say, forward. There is the first point about, I think, rethinking, and we call it with an English word, retooling. It means that in this scenario where a lot of pressure is on the profitability side, there is, as Alessandro was mentioning, huge need to free up resources to invest in technology, but also in adapting processes and business to the regulatory obligation, I think pushes a lot of institutions to really rethink about the fundamental business choices that they have today. And I think this is something that will be much more accelerated than in the past, because the freedom in terms of ability to do more businesses in more countries, I think is constrained. It's constrained by the resources and constrained by the fact that as of today, this industry is not paying the cost of capital. It was not the same 10 years ago, basically. So what does it mean? It means first thing is that a lot of players will have to really redefine the businesses in which they are willing to develop and have scale. And I think in the retail banking, what is important is on a country base, local scale still matters. And this can also allow having better returns. But there is also a question about how you become much more differentiated in business like retail, where a lot of the things will become electronified, as in the wholesale, but in the retail has been always a little bit lagging. But as much as 50 or 60% of the customer will be willing from tomorrow to interact totally and digitally with the bank, then the question is what I stand for the client. And then the second point about how the strategy will change and how the game will change is that despite of discussing about the number of branches we could keep on a country, on a city, etc., I think there is the whole issue about how we evolved the model through which I serve my clients. I need much more people able to provide expertise on an omni-channel basis, through chats, through video conferences, ability to drive more choices for this client. This is quite an important point, because in terms of resources means that there is a huge upskilling effort of the industry, notably the retail banking industry, the investment management industry, where basically we have to shift the skills from a pure transaction mode to a much more advisory mode. And this is massive, because when you look about the number of people working on the front line on this industry is huge. The third point is more about, given that it's an industry that structurally now doesn't earn the cost of capital. It means that the way they operate the business, the processes, the IT platform, the complexity of the organization cannot be afforded anymore. And that means that structurally, a bank has to run the business with a much lower cost run rate. And these, we are not in the magnitude of 10% a year or less. We are in the magnitude of 20, 30% a year less. And this you cannot only do by just doing incremental approach. There is a whole point now around restructuring the value chain in a way that, for example, I can be the one who is the more legitimate to talk to a client to serve his financial needs, but I'm not the one who has to provide the product and let me say, manufacture it at 100%. Why? Because maybe I cannot afford it. Maybe I have not the right competencies. So there is the whole point about how I structure my operation and my distribution network in a way that I can do it more efficiently. So we will be also seeing much more cooperation among players, I would say, among even competitors sometimes on some areas, and also more cooperation about new players that could easily provide the type of solution and competencies, front end and back end, to come back to the point of Alessandro, and this in a much more efficient way. These are major shifts. I think the COVID situation has very much accelerated those thinking, and I think in the future we will see much more partnership. They are already in areas like payments, but there will be more, I think, about in areas like asset management, where scale is important. There will be more and more also in providing specialized services, for example, services for small and medium enterprise, where specific advisory, ability to provide a very cheap hedging solution the bank cannot afford anymore. They could use a fintech. So these are the type of shift that I think are very much accelerated by the situation. And last but not least, I think there is a point about the fact that in itself, COVID has been a sort of quite unusual, unique, and non-planned stress test. And all the model about simulating and modeling what would be the reaction of a bank to face that stress had been not easy, because the pandemic risk was not very much high in the radar screen. But on this point, I think the point where structurally the business will have to change is the ability to work on a much more, I would say, simple way. If I pick up one very pragmatic example, in March, a lot of financial institutions had to do the quarterly reports in a much more simple, fast way, simply because of the crisis, simply because everybody had to work from home, simply because they had to go to the essential tasks to be done. And so this has created a huge demand of simplifying also the way they interact, not only with clients, but also internally. So in a nutshell, there are quite a few trends that this crisis, I think, will importantly affect how the bank and financial institution will have to react forward.
Yeah, it's going to be interesting to see what's going on in the financial landscape. And Alessandro, given that you are based in London, I can't avoid to ask you about Brexit. Brexit, by no doubt, is going to be a game changer. So what's going to happen to asset management, advisory, investment banking, all the different sectors that belong to the financial system? How is this big move going to affect our business, our life, our relationship with financial intermediaries?
So I think that there are two elements to consider when we talk about what's happening to financial intermediaries, banks in general, and all the financial market players like asset managers, etc. One is clearly Brexit on one side, and that is an event that is due to happen on the 1st of January of 2021. So we only have about a month and a half, a bit more than a month and a half to address it. But where the effects of Brexit on the financial markets, sorry, not on the financial markets in terms of the prices of stocks or bonds, but on the behavior of the players in the financial markets, will not be all seen on the 1st of January. And this is due to a variety of reasons, starting from the fact that neither clearly the British regulators, but who were on the receiving end of this, but mainly the European regulators wanted to create a cliff edge where from one day to another everything had to change. The impression that all the players have is that while on the 1st of January, there will be only a certain amount of regulated activities that won't be able to be performed any longer from outside the European Union, in this specific example from London, there are a lot of things that eventually will be added to the list of prohibited activities. Said in other words, the opinion that everybody has and the fear that everybody has is that the European regulators will just start turning the screw and turning it slowly but surely as time goes by, and as they realize that one part of the exercise has been done without creating too much disruption, they will make another turn. They will give another turn to that screw and force an additional element of business to be moved into the continent. Just to give you some idea about numbers, a bank like JP Morgan has about 16,000 people that work in the UK. With Brexit, the idea is that JP Morgan will move about 600 people overall into the continent, in between those that have already been moved, those that have been hired in the continent to do activities that were done in the past, and those that are going to move before the 1st of January and in the months right after. The fear that at the top of the house we had when I was still there was that within 5, 6, 7 years, probably half of the people that we currently have in the UK, we currently had as JP Morgan in the UK, would probably be one way or another relocated to Europe. And this is because it is just normal that as you start moving more and more people into Europe, you have to start not only front office, but you have to start moving also the back and middle office activity, the supports, the operations, the technology that we were talking about earlier. But also there are a lot of activities that currently we believe are the regulators are, and I say we believe because I mean this is all interpretation and all done out of conversations, that unofficial conversations with the regulators, but where the understanding is that they're not going to be sanctioned. That a lot of trading activities, a lot of advisory activities, a lot of activities that are not the outright selling of a product can be still done out of London. The conviction I have is that a lot of these things will be we will have to move into the continent. Likewise, for the asset management industry, there is right now the reliance that the ability to work on a delegation basis, i.e. where you have a UCIT fund that is a Luxembourg fund, for example, that therefore is any European investor can invest in without having any too much of a regulatory burden like the ones that intermediaries have if they want to sell offshore hedge funds or things like that, is now a product. The UCIT fund is a product that can be managed from outside the European Union, thanks to the ability that the fund company itself has to delegate the management activity to an entity that is not sitting inside the UK. And this was always done and was always there because the vast majority of the activity was done inside the UK. There was a very, very small inside the European Union, mainly in London, that was part of the European Union, and therefore it was really a very small amount of funds, UCIT funds, that were de facto managed from outside the EU. Now that London is not going to be part of the EU any longer, this became a big question mark for the regulators and the industry in terms of how will a portfolio manager that sits in London can manage a UCIT fund, which is a European regulated because Luxembourg-based product. And for the moment, this is not changing, but the fear that everybody has, and this fear comes from already certain types of statements that have been made, is that it's only a matter of time that this could change. Again, how much the screw gets turned and with what pace that turning happens, that will depend on, in my opinion, on the market environment, mainly, i.e. regulators want mainly not to create too much unnecessary disruption to the financial markets, but also to the political agenda, where clearly there will be a lot of pressure from politicians to bring as much business to the continent as possible. And I mean, the clear example, and that is based in Paris, and Paris is the location that also JP Morgan had chosen to have not the legal headquarters, which is in Frankfurt, but where the financial hub where people are going to be for JP Morgan is actually Paris. Why was Paris chosen? Because France was probably the most active country to try to come up with incentives for firms to move their people into the continent, and these among the countries that had the perceived political and fiscal stability to be able to home a large financial institution. So unfortunately for our country, that in my opinion did an extremely good job in trying to come up with incentives to bring as many of these expats to relocate to Italy. It was almost impossible for any of the major banks to decide to relocate their main financial hub into Milan or any other city in Italy, simply because of the instability of not only the political instability, but mainly the situation that Italy has on the debt to GDP, and therefore the potential instability that foreigners associate with our country, where we might agree or disagree with. I personally disagree of how much of a big risk that is, but it's certainly a headline risk that the CEO of any of the major banks was not prepared to take. So the only few countries that were allowed to be considered were clearly Germany and France, and then some of the other smaller countries like Holland, Luxembourg, and ultimately Paris did a much better job. So I think that there is certainly that trajectory that we have seen already happening, and that we will see happening. At the same time, though, I think that in terms of change of the European landscape of financial institutions, another major element that has started to create some changes, and that, in my opinion, will create a lot more changes. But then, Giorgio, tell me where, if you want me to talk about it now, if you want to talk about it a little bit later. But I think it's the banking union directed, the series of initiatives that are part of the so-called banking union.
Let's go back to this later. Alessandro, because I have I still want to raise a couple of questions, but we have to be very quick because we only have 10 minutes from now on. So going rapidly back to Ada, you already said, Ada, that COVID pushed us to do a super fast course on the use of digital tools, and this is changing the relationship between financial users and financial providers, let's say. So I would like to ask you, what is going to be, in your view, the long-lasting implication of this pandemic emergency in terms of organizational models for business in finance?
As just linking to what I said before, I think there is a question about changing the rules of the game in terms of much more cooperation and partnership, simply because resources are rare, and this means that there could be areas where a financial institution will divest a part of businesses where they cannot have scale and they cannot sustain investment. And there are already areas within financial services where this is happening already since years. I pick up one is payment. Payment is an area where banks in Europe, at least, have been more or less divesting over time. And the one who picked up the market consolidation are actually private equity funds who are creating, doing build-up across Europe. And I pick up one example, is actually an Italian one where, with the work done on Cartasi, now Nexi, that is probably combining itself with another Nordic company. So these are areas where banks have been actually on purpose or not deciding to leave. So there will be more of this. There will be probably also more partnership among players. Asset management is one. Scale is important on a global scale is important. And so when you have less than 1 trillion asset under management, you cannot have higher profitability. So even big groups like BNPP or HSBC or Deutsche Bank, who cannot be in the 1 trillion club, have more or less to think about what they do with this business. I think this is an area where we will see more of this. And then there will be the area of I think, and that is quite the question for going forward, given the scenario we are going to face, I think that there is a point about creating bigger European players in Europe, actually. I think, Alessandro, you are mentioning that when you have JP Morgan investing 11 billion on technology, and they can use the higher margin of US market to really do great business in Europe, and even expanding themselves in areas like lending, I think there is also a need for going forwards of strengthening the size and the strengths of European players. And so I think there will be maybe more consolidation, maybe furthered now by regulator, much more than has been in the past. This is an area where I see there could be changes, actually.
Sorry to interrupt. Just in a sentence, what is your impression about the Capital Markets Union project? Is this going to be effective towards delivering better services, better products, and what really our firms need to have a stronger, sounder financial structure?
I would say definitely yes for the final clients, consumers, firms. It is a way to have better services, more efficient. I think it also creates a much more, I would say, linear, but also healthy banking system in Europe. I think there is a lot of fragmentation. So I think Capital Markets Union can also favor the fact that we have less but stronger players. And this is something that will end up, I think, increasing the resilience of the sector going forward.
Thanks a lot. So let me go back to Alessandro for a couple of very quick questions. One, Capital Markets Union is something that we're working on. The banking union is something that we should already have, more or less. It's not totally finished. No, there's still some job to do. I would like to ask you a quick comment on what you think is the result, the outcome thus far. And then just one sentence about the future of Chinese banks in European finance.
So banking union, I mentioned it earlier because I think that banking union is, people think that it's mainly done. The reality is that, in my opinion, is far from being done. Let's not forget that when it was envisioned the banking union, three pillars were identified. One was the supervision pillar, the other one was the resolution pillar, and the other one was the deposit insurance pillar. Supervision was easy, implemented in 2014. Everything moved to the ECB for the main banks, at least, and relatively uncontroversial. Then everything was controversial at the time, but relatively uncontroversial. Banking resolution, a bit more controversial in terms of how to do it, but also not particularly crazy to think about how we could look at resolution of European banks in a common way across the market. And therefore, 2015, 2016 was already implemented. When we went to deal with deposit insurance, all problems came to the surface. And this is what is blocking the banking union from happening. The problem at the heart of why the deposit insurance mechanism is not really been implemented in a full way, if not about the 100,000 euro of minimum deposit, is the fact that there is a very, very different opinion around Europe on how to deal with the European government bonds. European government bonds are now, from a regulatory capital point of view, they're all considered the same, i.e. they're all zero-weighted. The problem is that from the point of view of the perceived amount of risk that they have, they're not perceived to be the same. And this is creating a massive block in terms of understanding how can we have a European system to ensure all the deposits and making investing or depositing into an Italian bank be exactly equivalent as putting your money into a German bank or a French bank. And unfortunately, that is the heart of the European problem. Up until, in my opinion, we will have real European bonds, i.e. bonds that are guaranteed in solid by the every member state, we will never get out of this impasse. And unfortunately, for that to happen, we will need to move from a European monetary union to a fiscal union, and that hopefully will happen soon. And every crisis, in my opinion, allows us to make a step forward in that direction. So not every crisis happens without positive consequences, but that's the heart of the problem. So that's also the reason why we haven't seen yet, and I'll try to be as fast as possible, we haven't seen yet the same amount of consolidation in the banking sector in Europe that you would have expected. Why JP Morgan, Wells Fargo, Bank of America have not come to do business in Europe? As I was saying, okay, JP Morgan could come and start lending in Europe, but we could potentially kill every bank in Europe because we could be more efficient, more faster, cheaper, but we're not doing it. I mean, JP Morgan is not doing it because now doing business in Europe is not one thing. It's doing business in Italy is one thing, doing business in France is another thing, doing business in Germany is a different thing. So it is almost impossible for a foreign player to come in. And that is also the reason why in the retail space, especially, I'm talking about the wholesale, the easier, but with complications also there. That is also the reason why the Chinese banks have not come in yet. And in my opinion, this is also explains also a little bit why the regulators are a little bit afraid of just opening everything up, because they are afraid that if everything gets opened up without having reinforced and allowed for some of the European champions to strengthen themselves, they would be annihilated by the Chinese and the American counterparties. So there is an element of that I totally underwrite as an approach. But to have a proper European Union and have European banks consolidating, we're almost in a chicken and egg type of situation. If you don't do it, you cannot consolidate. If you don't consolidate, you cannot get stronger. And but if you open it up, the foreigners can come in, and that's a problem. And the foreigners, as you were mentioning, are extremely big. If you look at the top 5 banks by asset class, they're all Chinese banks. They just dwarf the size of the American banks, including JP Morgan, and they dwarf, but to not even comparison, the size of European banks from a size of total assets that the banks have. From a market cap point of view, it's different. We still have American banks at the top of the market cap league table, and the Chinese banks are a little bit further behind, and the Europeans are not too much behind, especially BNP and Santander. But this is a problem, but also a safety net for European players that they're not going to be assaulted by Chinese and American competitors.
Thank you, and I think this is a beautiful link to the suggestion that I was giving at the beginning, that China is going to be the only positively growing country in the world economy, and how this is going to affect the behavior also on financial markets in the next decade, because this is what we are going to witness in the future. So thank you, Alessandro. Thank you, Ada. I think this has been a stimulating conversation, and I think that Andrea has a lot of ground to provide his final remarks.
Absolutely. Thank you very much to everybody. Thanks a lot to Professor Di Giorgio. Thanks, Giorgio, for having stimulated and moderated such a wide and inspiring discussion. Maybe too many grounds to make some final remarks that I would like to divide, remaining briefly, very brief, into chapters. First of all, some remarks linked to my role as chairman of the Alumni Association, which links to what Professor Prencipe said at the beginning. This format of masterclasses has been designed by Luis during the pandemic. The idea of these masterclasses is to involve as main actor our alumni all around the world. So it's a form of collaboration within the Luis system, absolutely, which I think has given tonight, but also in the previous example, the idea of the quality and quantity of the human capital that Luis has generated across time, and that now is widespread all around the world. And this gives the possibility to collect insights from different places and different views. Just to go back to what we have heard tonight, obviously, looking at Brexit from London is not the same thing as looking at Brexit from Milan. Probably in Milan we hoped and maybe thought that we could attract at least part of the banking activity that moved outside of London. I think that Alessandro made, I would say, clear, straightforward, unfortunately, remarks for which in the decisional process this was not really the case, and in fact has not happened. So this format of masterclasses gives us the possibility to collect together distinguished representatives of the alumni community to discuss with distinguished representative of the LUISS academic community in the moment in which to convene together is more important from one side and more difficult from the other side. So we think that this obviously will have to continue. We are also designing the next masterclass that we are going to launch very soon. But obviously, I don't want to close without some remarks and also putting a final idea on the table on what we have heard. For sure, we are living in a period of incredible change, tremendous change that has not started with the pandemic. Pandemic has been maybe an acceleration from one side or a deceleration from our side of a certain phenomena. For sure, there will be adjustments when, and we hope very soon, this period will definitely finish with vaccine, drugs, or in the way that it will be possible. This is probably in a sea of uncertainty in which we live, and we have had some remarks on this during the conversation, probably is the only certainty. It is going to finish. We hope soon. Someone is less pessimistic, is more pessimistic and less optimistic, but this remains a certainty. For sure, financial markets in this pandemic has a key role, and we have discussed this. First of all, it has been, and it is very important that the chain of transmission of the crisis will not enter the financial market. And this is probably the real meaning of the ultra expansionary monetary policy that we have observed. A crisis of 2008, in particular in Italy, has had a very long tail. In fact, the new one has started when the old one was not still finished, because there was this transmission to the financial system and to the banking system in particular. I think that this is the key role of financial system, is to preserve himself, not only for its own safety, but also for the safety of the whole economy. Second point, which is the question, or let's say the provocation, in particular as an insurer, that is my other hat that I put on the table, is this. But in the future, can the financial markets, can financial products play the role of covering firms, people, enterprises, whole economy from catastrophic risk like pandemic? 3 years ago, World Bank launched a tool, a financial instruments that was named at the time a pandemic bond. Was a very small issue. Nobody cared at the time, but the final result was that the financial markets have absorbed an incredible small piece of this risk. Financial markets have a feature or a couple of features which are very important from this point of view. They usually manage completely different, and so the correlated risk with the pandemic, and in particular, they are incredibly huge. In the insurance sector, the debate is, can the insurance player absorb part of this future risk for future events like future pandemic? The answer usually is partially, because they are not big enough to absorb this risk. So they need state. I would like to add, let's think to add financial market that overall are even bigger than states, in particular when the liquidity is so abundant. So with this final remark, which I think is strongly linked to the discussion that we have had and which have underlined several set of topics, I would like to conclude thanking again our moderator, Professor Di Giorgio, and our alumni, Ada and Alessandro, for their participation and insightful remarks. Thanks a lot, and hopefully see you soon at Rome or in London, or when it will be possible to move again and to meet in person.
Thank you. Thank you.